Adjunct Professor Moran, Macroeconomics 111, and in this session we're going to explore the relationship between the resale value of a bond and its interest rate and price. The Federal Reserve is going to try to change economic conditions, either recession or inflation, by changing the money supply. By changing the money supply, they will cause the price of money to change. The price of money is interest rates. When interest rates change, it will affect the amount of durable goods consumers buy and the amount of capital, construction, and inventory businesses buy. The government will change the supply of money by buying or selling government securities. Those government securities are Treasury bills, notes, and bonds. We're just going to call them bonds. A bill is a Treasury security issued for less than a year. A note is issued for 2, 3, 5, 7, 10 years. And a bond is issued for 30 years. We're just going to call them all bonds for our purposes. When the government sells a bond, it is borrowing money from the investing public. So if you're an investor, you could buy stocks or you could buy bonds. You could buy bonds issued by private corporations or bonds issued by the federal government. So, the government will provide incentive for people to buy and sell bonds by either offering a higher or lower interest rate or price, which will give the incentive for people to either buy the bond at a bargain or sell the bond at a profit. So, in order to get the current market price of a bond, you take the coupon value and divide it by the current interest rate. The coupon value divided by the current interest rate. Coupon value divided by the current interest rate gives you the current resale price of a bond. So what is a coupon? Perhaps some of you have savings bonds. This is not what we're talking about. When you buy a government savings bond, in the example we're talking that's not coupon, it's called a pure discount bond. So for example, a $20 bond can be bought for less than $20. You're earning interest internally to the bond. Unlike a bank account which pays you interest as you go and you withdraw the interest as you go, in a pure discount bond, you get all the interest at the end. So you buy the $20 bond for less than $20, and the difference between the maturity price, the price on the bond, and how much you paid for it is the interest you've earned. But there are other types of bonds called coupon bonds, and these bonds explicitly state how much they will give you in every accounting period until the maturity date. Right? So if you take and now interest rates change over time. So when interest rates change, so will the resale value of the bond. Because as interest rates go up, the coupon will go up on bonds, and your bond won't look so attractive, so the resale price of your bond will fall if you decide not to hold it to maturity. But if interest rates fall, then the coupon price on bonds, on new bonds, will be less. So your bond looks more profitable because your coupon was determined when interest rates were higher, and so if someone wants to buy your bond to get that higher coupon, they'll have to offer you a higher price. So let's practice calculating resale values of bonds. So let's assume you buy a bond and current market interest rates are 5%. The coupon would be 5% of 1,000 or $50. Let's say though that interest rates fall to 4%. A new bond would only offer $40, but your bond continues to pay $50. If you wanted to sell your bond, you could get more than $1,000. Because the other bonds are selling for $1,000 but only paying $40. Your bond is paying $50. So you take the coupon of $50 and divide it by 0.04, 4%, and you get $1,250. If current interest rates fall further to 2.5%, new bonds will be issued with a coupon of $25. Since your bond is offering a higher coupon, if you wanted to sell it, you could get more than the original amount you paid for it, $1,000. And so 50 divided by 0.025 gives you a resale price of $2,000. If, however, bond price, current market interest rates change and increase, then new bonds issued would have a coupon of $60, 6% of 1,000. Your bond is only paying $50. So if you wanted to resell it, you would have to accept less money than the $1,000 you originally paid for it, and you would get $833. All right. If interest rates rose to 7.5%, new bonds would have a coupon of $75. Yours is only paying $50, so you would have to take a further discount when you sold it, and that would be $666.67. This is going to be very useful to know when we attempt to explain monetary policy when the Federal Reserve tries to influence the money supply and resulting interest rates by buying and selling bonds in the open market.